Assalamualaikum warahmatullahi wabarakatuh. I am Shaima from IAP. Are you Nur Shadrina?
Waalaikumsalam, yes, I'm Nur Shadrina. How can I help you, Shaima?
Did you remember we're gonna make text?
I'm sorry, I almost forget about it. Can we start now?
Yes, let's restart. Think of income deduction as a kind of discount for our income tax. The government allows us to subtract certain eligible expense from our total income. As a result, the income that will be taxed becomes smaller. Understanding the rules about this discount is really important. It can make the tax we pay more accurate, in line with the regulations, and we can also plan our finance better, so we are not surprised when paying the tax. Today, we are going to discuss two main types of the discount. And the first is expense that can be deducted or deductible expense. And the last is the expense that cannot be deducted or non-deductible expense. We will find out what the difference and why this is important for all of us. The primary objectives of this presentation are to provide a clear and comprehensive understanding of deductible expense or costs that can reduce taxable income and non-deductible expense costs that can. We will delve into the definitions of each and then referencing the foundational income, the tax law number 36 of 2008 and relevant implementing regulation. To solidify comprehension, we will present practical examples and illustrations showing how these classifications apply in real-world scenarios. Ultimately, this section will demonstrate the direct and significant impact of correctly identify deductible and non-deductible expense on the final income tax liability, underscoring its importance for accurate tax compliance and informed financial decision making. So the next slide is the legal basis. The first box is the Income Tax Law number 36 of 2008. This is the main regulation governing income, deductions, and the calculating of income tax in Indonesia. As we delve into the specific of deductible and non-deductible expense, it's crucial to understand the overseeing legal framework. Income Tax Law number 36 of 2008 serves as the primary legislation that dictates how income is defined, what deductions are permissible, and ultimately, how income tax is calculated in Indonesia is the foundation upon which all other tax regulations regarding income are built. And the middle box is the Article 6 deductible expense. Specific the types of expense that can be deducted from gross income when calculating taxable income. Within this main law, Article 6 is the key section that outlines what types of expense business and individual can subtract from their total income to arrive at their taxable income. This article provides a general framework and subsequent regulation often provide more specific detail and condition for this deduction. Example is the salaries and wages, and then business-related interest expense, and then depreciation and amortization, and operational expense directly related to business activity. And the last box is the Article 9, non-deductible expense, least expense that cannot be deducted from gross income. Conversely, Article 9 of the same income tax law explicitly least expense that are not allowed to be subtracted from gross income. These are often expenses that are considered personal in nature, represent a distribution of profit, or are punitive in nature. Examples are dividend paid to shareholders, fines or penalties from legal violations, personal expense of owner or manager, donation that do not meet specific requirement. And the summary is that it's crucial to remember that simply incurring a business expense doesn't automatically make it deductible. To be eligible for deduction, this expense must comply with the specific legal provisions outlined in the income tax law and its related regulations. Incorrectly classifying non-deductible expense as deductible can lead to tax corrections by the authorities and potentially administrative penalties. Deductible expense. Deductible expense are business-related expense that can be subtracted from gross income to determine taxable income. This expense must be reasonable, necessary, and directly connected with earning income. The example of deductible expense, like salaries and wages, is a payment to employees for service related to the company's business activities, and office rent, rental payment for office space or business facilities used for operational purpose, and then depreciation of fixed asset, periodic allocation of the cost of tangible assets like machine or vehicle over their useful lives. And then interest expense on business loans. Interest paid on loans obtained to fund business activity provided it is properly documented. And the last is other reasonable operating expense, like utilities, office supplies, and then business-related travel expense, and then repair and maintenance costs for business assets. The next slide is the non-deductible expense. Non-deductible expense are costs that cannot be deducted from gross income in the calculation of taxable income. These expenses are generally not related of the company's core business activity or are specifically prohibited by tax law. The example of non-deductible expense are dividends. It is the profit distribution to shareholders are not considered business expense. And then tax finance and penalties. It includes section for late payment and the payment of tax or other legal violation. And then personal expense of owners or managers. Example, personal travel, entertainment, or household expenses using company fund. And non-qualified donation.
We're going to the comparison between deductible and non-deductible expense. There are the definition, purpose of expense, common examples, requirement, and tax effect. But here, the deductible expense purpose is to generate, collect, or maintain business income. Meanwhile, non-deductible expense is for personal benefit or unrelated to business. And then the requirements of deductible expense must be reasonable, directly relate to the business, and backed by documentation like invoice, contracts, etc. Meanwhile, non-deductible expense usually unreasonable, unrelated, or even illegal expense. Okay, now let's move into the case study so you can better know about deductible and non-deductible expense. The first case study about the PT Sejahtera Makmur is a manufacturing company that in 2024 incurred various operational costs. They claim the following expense as tax-deductible expense. There is employee salaries, factory electricity and water costs, cost of advertising new product on social media, and depreciation of production machinery. The problem is, during the tax audit, the tax auditor questioned the advertising cost. It turned out that some of the advertising costs were used to promote the director personal events outside the company activities. So how we can solve this problem? The first is we can divide the deductible expense and non-deductible expenses. The deductible expense include employee salaries, factory electricity and water, depreciation of production machinery. Meanwhile, the non-deductible expense consists of cost of advertising new product. Why? Because this advertising new product is turned out into promote the director personal events outside the company activities. Let's move into the next case study from CV Berkah Abadi. CV Berkah Abadi is a company engaged in IT consulting. In 2024, they incurred the following costs: employee training costs for IT certification, corporate income tax late fee, CSR, and expense for director's birthday. Problem is, CV Berkah Abadi lists all of these costs as a deduction from taxable income. So we have to divide it which one is deductible and non-deductible expense. The deductible expense consists of employee training and CSR, but for non-deductible expense consists of tax late fee and director's birthday. So I wanted to explain a little bit about the CSR expense. The CSR expense might be a deductible if it's billed for benefiting the community. But if there's too much emphasis on the company branding, it might be considered more promotional, and then it's leaned toward being non-deductible expense. Here, CV Berkah Abadi is used their CSR to build a part. If it's beneficial to the community, so it's become a deductible expense. Anyway, have you ever heard about WorldCom scandal in 2002? So at the end of the 1990s, WorldCom was a telecom giant on the rise. They were aggressively acquiring smaller companies and expanding their market share, positioning themselves as one of the largest telecom company in the United States. Investors flocked to WorldCom, driving up stock prices and fueling the company massive growth. From the outside, everything looks perfect. But behind the scene, cracks were starting to show. As the dot-com boom faded and the economy shifted, WorldCom began facing financial challenge. The company's revenue was slipping, but rather than openly addressing the struggles, WorldCom's leadership decided to hide them through a very clever accounting trick. The trick was simple, yet devastating. WorldCom took legitimate operating expense, like network maintenance and employee costs, which should have been classified as regular deductible expense, and reclassified them as capital expenditure. Capital expenditure are typically long-term investments that are not immediately expensed, and therefore not directly deducted from taxable income. By doing this, WorldCom made their financial appears much healthier than they actually were. This allowed the company to inflate its profits and keep the stock price high, despite the fact that the company was sinking deeper into debt. They managed to hide billions in operating costs, all while presenting a picture of growth and profitability. The scandal break in 2002. The truth came to light. The scandal breaks in 2002. The truth came to light. WorldCom's internal auditors uncovered the massive fraud. After a thorough investigation, it was revealed that the company had falsely reported over 3.8 billion US dollar in expense, hiding them in the capital expenditure. This wasn't just a simple accounting error. It was a deliberate act of deception to manipulate the financial statements and mislead investors, analysts, and regulators. WorldCom's stock price collapsed. Investors lost billions of dollars as the true financial conditions of the company was exposed. The company filed with bankruptcy, making one of the largest bankruptcies in US history at the time.
I guess that's all about income deduction in tax. Is there anything else, Nur?
Well, I think that's enough to explain all about income deduction.
Okay, let's submit the text now. I will leave the phone to Assalamualaikum.
Sure, Waalaikumsalam.